Preparing for accounting at American Water interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work in accounting at American Water? I am interested in American Water because accounting here supports an essential service while involving complex regulated utility issues. I would bring strong attention to detail, disciplined reconciliations, and an understanding of how transactions flow into financial statements, rate filings, and management decisions. I also value the company's long-term infrastructure focus. This role would let me develop technically while contributing to accurate reporting, effective controls, and financially responsible investment in water and wastewater systems. While answering, connect your accounting skills to essential water and wastewater services, regulated operations, public company reporting, accuracy, ethical judgment, and the opportunity to support infrastructure investment and reliable customer service. Question 2. What makes utility accounting different from ordinary corporate accounting? Utility accounting is shaped by regulation as well as ordinary business economics. A regulated water company may recover approved costs through customer rates, so accounting must track rate base, capital additions, depreciation, and regulatory assets or liabilities. The business is also highly capital intensive, with long-lived infrastructure and recurring maintenance. I would therefore focus on accurate project coding, proper capitalization, reliable billing records, and clear reconciliation between operational data, regulatory schedules, and generally accepted accounting principles reporting. Make sure to cover regulation, rate setting, rate base, regulatory assets and liabilities, capital-intensive operations, depreciation, customer billing, and the need to align accounting with both generally accepted accounting principles and regulatory requirements. Question 3. How does rate regulation affect a utility's financial statements? Rate regulation can change the timing of expense recognition and revenue recovery. When a regulator permits a company to recover a qualifying cost in future rates, the company may record a regulatory asset, assuming recovery is probable. Conversely, amounts collected before related costs are incurred can create regulatory liabilities. I would assess the governing order, recovery period, and probability of collection, then ensure amortization, disclosures, and journal entries remain consistent with both the order and applicable generally accepted accounting principles. In your answer, explain authorized recovery, matching costs with future revenues, regulatory assets and liabilities, probable recovery, jurisdictional differences, and how rate decisions influence earnings, cash flows, and disclosures. Question 4. What is a rate base, and why is it important? Rate base is the investment on which a regulated utility may earn an authorized return. It generally includes eligible utility plant in service, net of accumulated depreciation, plus approved items such as working capital, depending on jurisdiction. The accounting importance is significant because capital additions, retirements, depreciation, and allowances can change the rate base. I would maintain precise asset records because errors may affect customer rates, regulatory filings, allowed earnings, and future recovery. Be sure to mention utility plant in service, accumulated depreciation, working capital or other permitted components, authorized return, jurisdictional approval, and how rate base influences customer rates and investment economics. Question 5. How would you determine whether a capital project should be capitalized? I would first determine whether the expenditure creates a new long-lived asset or materially improves an existing one. I would review the project approval, scope, invoices, labor support, and capitalization policy, then separate eligible direct costs from repairs, maintenance, and administrative expenses. Qualifying amounts would remain in construction in progress until the asset is ready for intended use, when depreciation begins. I would also verify regulatory treatment, because accounting capitalization does not automatically guarantee rate recovery. Focus on whether expenditures create or improve a long-lived asset, project authorization, construction in progress treatment, direct costs, repairs and maintenance, placed in service timing, and supporting documentation. Question 6. When should depreciation begin for a utility asset? Depreciation should generally begin when the asset is placed in service, meaning it is substantially complete and available for its intended use, rather than simply when spending starts. Before that point, qualifying costs remain in construction in progress. I would confirm the in-service date from project or operations documentation, apply the approved useful life and method, and reconcile the calculation to the fixed asset subledger. I would separately consider whether regulatory schedules use different conventions or lives. Discuss the placed in service concept, readiness for intended use, construction in progress, useful life, residual value, method, monthly conventions, and reconciliation to the fixed asset subledger in regulatory records. Question 7. How would you account for construction in progress? Construction in progress captures qualifying costs for assets that are not yet ready for use. I would record supported materials, contractor invoices, and eligible internal labor to the correct project, while expensing routine repairs or unrelated overhead. Each close, I would review aging, commitments, project status, and unusual balances. Once operationally complete, I would transfer the asset to the appropriate plant category, begin depreciation, and reconcile the project ledger with the general ledger and regulatory support. Mention accumulating eligible project costs, excluding routine repairs, monitoring commitments, transferring completed assets, starting depreciation, reviewing project status, and reconciling subsidiary records to the general ledger. Question 8. How would you account for water and wastewater revenue? I would recognize revenue for water and wastewater services as customers receive the service, using approved tariffs and applicable service charges. Because billing dates may not match month-end, I would estimate unbilled usage from consumption patterns, meter data, and historical experience, then reverse or true up the estimate when actual bills are issued. I would test cutoff, unusual adjustments, and rate changes, and reconcile billing system totals to the general ledger and cash collections. Cover billed and unbilled consumption, tariffs, service charges, estimated usage, cutoff, collectibility, contract terms, adjustments, and reconciliation between billing systems, cash receipts, and the general ledger. Question 9. What is an unbilled revenue accrual, and how would you validate it? An unbilled revenue accrual represents service already delivered but not yet billed at period end. I would calculate it using recent meter reads, consumption history, customer counts, approved rates, and known weather or operational changes. To validate the balance, I would compare the estimate with subsequent bills and cash receipts, investigate large variances, confirm proper reversal mechanics, and document assumptions. The key risk is recognizing revenue for usage that did not actually occur or applying an incorrect tariff. Explain services delivered before billing, usage estimates, meter reads, historical trends, rate changes, subsequent billing, reversals, materiality, and evidence supporting management's estimate. Question 10. How would you handle an allowance for doubtful accounts? I would assess the allowance using receivables aging, historical write-offs, customer payment behavior, current economic conditions, and any specific collection issues. Residential, commercial, and governmental accounts may have different risk profiles, so I would avoid applying one unsupported rate to every population. I would reconcile the allowance roll forward, compare estimates with subsequent collections and write-offs, and document management's judgment. I would also ensure policy compliance and consistent treatment across reporting periods. Discuss receivables aging, historical loss rates, customer classes, economic conditions, payment behavior, write-offs, recoveries, management review, and consistency with the applicable expected credit loss framework. Question 11. What are regulatory assets and regulatory liabilities? A regulatory asset generally represents a cost that has been incurred but is expected to be recovered from customers through future rates. A regulatory liability generally represents amounts collected or obligations that will benefit customers in future periods. I would only record these balances when the regulatory framework and evidence support recovery or refund. Then I would track the approved amortization period, reconcile activity to orders, and disclose significant balances and judgment appropriately. Be sure to define each balance, explain permitted future recovery or refund, discuss probability, amortization, supporting regulatory orders, and the risk of recording amounts without sufficient evidence. Question 12. How would you evaluate whether a regulatory asset is recoverable? I would evaluate the specific commission order or regulatory mechanism supporting recovery, the remaining amortization period, actual rate treatment, and the company's current rate case position. I would also consider whether regulators have challenged the balance, whether recovery remains probable, and whether customer rates can absorb it. If evidence weakens, I would escalate promptly, reassess the accounting, and consider impairment or a write-off. The conclusion should be documented with clear regulatory and financial evidence. Focus on regulatory orders, commission decisions, historical recovery, rate case plans, customer impact, probability assessment, amortization, impairment indicators, and escalation when recovery becomes uncertain. Question 13. How would you reconcile a fixed asset subledger to the general ledger? I would begin with prior period reconciled balances, then roll forward additions, transfers from construction in progress, retirements, disposals, depreciation, and other adjustments. I would compare the fixed asset subledger to the general ledger by asset class and investigate every unexplained difference. I would also review large additions, negative balances, old construction projects, and unusual retirement activity. Finally, I would retain supporting reports, evidence of review, and documented resolution of reconciling items. Mention beginning balances, additions, transfers, retirements, depreciation, disposals, project detail, reconciling items, monthly controls, and independent review of unusual movements. Question 14. How do asset retirements and replacements affect utility accounting? When a utility asset is retired, I would remove its original cost and related accumulated depreciation from the records and account for any remaining book value, proceeds, or removal costs according to policy and regulatory guidance. A replacement may be capitalized if it creates a qualifying new asset, while routine repairs are expensed. I would coordinate with engineering and operations to confirm retirement dates and scope, because incomplete records can distort plant balances, depreciation, and rate base reporting. Cover derecognition, accumulated depreciation, removal costs, replacement versus repair analysis, potential regulatory treatment, gain or loss considerations, and coordination between engineering, operations, and accounting. Question 15. What internal controls are important in a utility accounting close? Important controls include segregation between transaction preparation, approval, and posting, system access reviews, billing to ledger reconciliations, capital project approval, fixed asset additions testing, and independent review of estimates and journal entries. I would use a close checklist with clear owners and deadlines, require supporting documentation, and investigate exceptions rather than simply clearing them. Strong controls should prevent errors and detect them quickly, particularly in high-volume billing, capital spending, regulatory balances, and cash activity. Discuss segregation of duties, journal entry approval, account reconciliations, billing controls, capitalization review, access controls, estimates, close checklists, evidence retention, and timely escalation of exceptions. Question 16. Describe your approach to preparing a monthly account reconciliation. I start by agreeing the reconciliation's ending balance to the general ledger and confirming that the underlying source is complete. I then explain beginning balances, current period activity, and ending items, with supporting invoices, schedules, confirmations, or system reports. I age reconciling items, investigate unusual movements, and distinguish timing differences from errors. Before sign-off, I confirm reviewer approval, document conclusions, and escalate old or material items with a clear remediation plan. Explain agreeing to the ledger, identifying the source population, reconciling activity, aging differences, obtaining evidence, documenting conclusions, and escalating unresolved or unusual items. Question 17. How would you investigate an unexpected variance in utility operating expenses? I would quantify the variance and split it into price, volume, timing, and accounting drivers. For example, a maintenance increase could reflect storm activity, emergency repairs, a missed accrual, or incorrect project coding. I would compare the ledger with budgets, prior periods, purchase orders, invoices, accrual reversals, and operational explanations. After identifying the cause, I would record any correction, update forecasts if necessary, and communicate the conclusion with evidence rather than relying on a general narrative. Mention trend and budget analysis, volume and price drivers, accruals, timing, weather, maintenance activity, vendor invoices, coding errors, and communication with operational stakeholders. Question 18. How would you account for leases at a water utility? I would first identify contracts that provide control over an identified asset, including property, vehicles, equipment, or embedded arrangements. For qualifying leases, I would record the appropriate right-of-use asset and lease liability, determine classification, and use the correct discount rate and term. I would monitor renewals, modifications, payment changes, and new contracts throughout the year. A complete lease inventory and reconciliation between contract data, amortization schedules, and the ledger are essential. Cover identifying lease arrangements, right-of-use assets, lease liabilities, operating versus finance classification, commencement dates, modifications, embedded leases, and reconciliation to contract records. Question 19. What accounting issues can arise from a utility acquisition? An acquisition requires purchase accounting, including measuring identifiable assets and liabilities at fair value, recognizing customer-related intangibles where appropriate, and recording goodwill for the residual amount. I would pay particular attention to acquired utility plant, regulatory assets or liabilities, environmental obligations, debt, and customer receivables. After closing, I would validate opening balances, eliminate intercompany activity, integrate billing and fixed asset systems, and ensure acquired controls support accurate consolidated reporting. Discuss purchase accounting, fair values, goodwill, identifiable intangibles, assumed liabilities, regulatory balances, customer relationships, consolidation, opening balances, and integration of systems and controls. Question 20. How would you account for environmental remediation obligations? I would assess whether a present obligation exists from past events, whether a loss is probable, and whether the amount can be reasonably estimated. I would obtain current legal, engineering, and environmental assessments, evaluate cleanup alternatives and timing, and record the best supported estimate under applicable accounting guidance. I would not offset the liability with potential insurance recoveries unless permitted. Because estimates can change significantly, I would update the liability and disclosures each reporting period. Focus on identifying a present obligation, probable loss, reasonable estimation, regulatory requirements, legal and engineering input, discounting considerations, insurance recoveries, and disclosure of uncertainty. Question 21. What is the difference between operating cash flow and net income for a utility? Net income includes accrual accounting items, while operating cash flow reflects cash generated from operations. Depreciation reduces earnings without using current cash, whereas changes in receivables, payables, unbilled revenue, and regulatory balances can create timing differences. Capital expenditures are generally investing cash outflows, while debt and equity activity are financing flows. Therefore, a utility can report earnings yet experience cash pressure if infrastructure spending, collections, or working capital needs absorb cash. Explain non-cash depreciation, regulatory movements, working capital, receivables, payables, capital spending, financing flows, and why profitable utilities can still face cash pressure. Question 22. How would you ensure accurate cutoff at quarter end? I would establish a clear close cutoff and test transactions around period end based on when service was delivered, goods were received, or an asset was placed in service. For revenue, I would review meter reads, billing dates, and unbilled estimates. For expenses and capital projects, I would inspect receiving reports, invoices, contracts, and subsequent payments. I would record necessary accruals, confirm reversals, and investigate unusual post-close entries that could indicate period misstatement. Mention service dates, meter readings, invoice timing, goods received, accruals, capital projects, subsequent transactions, reversals, and targeted testing around the reporting date. Question 23. What would you do if a manager asked you to capitalize an expense improperly? I would first understand the rationale and compare the expenditure with the capitalization policy and relevant accounting guidance. If the cost did not create or improve a qualifying asset, I would explain why it should be expensed and show the financial impact. I would document the analysis and seek review from the controller or technical accounting team if needed. I would not post an unsupported entry because integrity, auditability, and reliable reporting are more important than short-term results. Emphasize accounting policy, objective evidence, professional skepticism, respectful challenge, escalation, documentation, correction, and the importance of accurate reporting over meeting targets. Question 24. How would you improve a slow or error-prone accounting process? I would map the current process, identify repetitive manual steps and recurring error points, and separate symptoms from root causes. For example, standardized templates, automated data validation, and system-based approval routing might reduce journal entry errors and close time. I would define owners, control points, and measures such as unreconciled items, late submissions, and correction volume. I would pilot changes, compare results, obtain stakeholder feedback, and preserve appropriate review rather than automating without governance. Cover process mapping, root cause analysis, standardization, automation, preventive controls, ownership, measurable outcomes, pilot testing, and preserving review quality during implementation. Question 25. Walk me through how you would handle a material accounting error discovered after close. I would contain the issue, preserve the supporting data, and determine exactly what was recorded, when, and why. I would quantify the impact by account, period, statement, and regulatory schedule, then assess materiality with the controller and technical accounting team. Depending on the conclusion, I would record a correction, consider disclosure, and involve internal and external auditors promptly. I would also identify the control failure, implement remediation, and document the full decision trail for governance and audit purposes. Discuss containment, fact-gathering, materiality, affected periods and statements, correction, disclosure, control deficiency assessment, communication with auditors, and preventing recurrence. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.